Good afternoon, and thank you for coming to Dean Mead's Real Estate Development Industry Group Seminar Series. This is the first in the series entitled Pitfalls in Planning for the Tax Consequences of Loan Workouts and Debt Restructuring. My name is Kim Rozenka, and I am chairman of this industry group. Dean Mead is a full-service business firm with three principal departments, those being tax, corporate, real estate, and litigation. We have offices here in Vieira, also in Orlando, Fort Pierce, and Gainesville. Our real estate development industry group is made of lawyers from all of these offices and all of the departments so that we bring a multidisciplinary approach to representing our real estate development clients. In addition to debt restructuring, our industry group lawyers have expertise in real estate development, land use, eminent domain and property valuation controversies, environmental law, agribusiness issues, tax and entity planning, and real estate related litigation. As I mentioned, I'm Kim Rozenka. I'm a partner in the Vieira office. I practice in litigation and land development. Also here is Mason Blake over there. He's a partner in our real estate department in Vieira. Rob Neighborhouse is a partner, tax estate planning actually, but he does have a tax background to some extent. Claudia Haynes Jones, she's our corporate department here in Vieira. Laura Young, she's an associate with our real estate department in Vieira. Rob Manning and Jason Pugh, they're both in the back, and they're both in our litigation department in Vieira. Speaking today are three lawyers from Orlando, Vicki Berman, Steve Lee, and Christine Weingart. They're up here. I believe you have seen some of their biographies on the invitation that went out, but I want to give you a little bit more information. Vicki is a partner in our Orlando office and practices with the real estate department. She represents buyers and sellers, landlords and tenants, borrowers and lenders, investors and developers in a wide variety of commercial and residential real estate transactions. She has principal responsibility for one of our firm's largest client, a REIT, which is currently the largest office landlord in Orlando. In addition to office leasing, Ms. Berman has significant experience in retail leasing as well. She is also on the team which represents the firm's largest client, a major Florida landowner, and has handled several significant transactions for the purchase and sale of real estate, including several 1031 transactions. Steve Lee is a partner in our Orlando office, and he practices with the tax department. He is board certified in tax law by the Florida Bar Board of Specialization. He represents businesses and business owners in connection with all types of business matters, including choice of entity on formation, acquisition, disposition, and reorganization of businesses, tax planning for the acquisition of real estate, including tax-free exchanges, and other general business matters, including employment and non-compete agreements. Christine Weingart is an associate in our Orlando office and practices with the tax department. She provides tax and business counsel to business owners, including corporations, LLCs, and partnerships, on all types of business matters. These matters include formation, termination, reorganizations of businesses. In addition, she has developed special knowledge of carbon credit trading and renewable energy tax incentives. Are there any accountants here today? Okay. We have a number for CPE credits, and I can give that to you at the end. There are also evaluation forms in your materials, and we ask that you fill those out and ask you to leave them with us so we can improve on our seminars. There will also be a question and answer period at the end. So with that, we'll turn it over to Vicki.
Today we're going to examine a number of scenarios for loan workouts and debt restructuring in order to highlight the possible tax consequences and other ramifications of workouts and restructuring. Our clients are calling us every day with loans in distress. In some instances, the loan has simply matured. The anticipated sale of the property or portions of the property has not materialized. Anticipated leases have not been made, or existing leases have not been renewed, or they are in default. The lender will not renew the loan, and no new lender will step in to refinance the loan. In some instances, the loan is not matured, but it's in default for all the same reasons. Financial covenants and the loan documents are in default, and the debt service cannot be met because the tenants have defaulted. So, what can be done? It is imperative that the borrower meet with the lender as soon as possible when these signs of distress arise. What we have seen over the last few years includes both simple and highly complex restructurings. In some cases, the lenders are willing to be creative And in other cases, they cannot or will not, for a variety of reasons, think outside the box. The degree to which the lender will be accommodating and creative depends upon a number of factors, including the culture of the lender, the incentives or disincentives given to them or to any servicer who might be involved, whether or not the loan has been securitized, whether or not the loan has been personally guaranteed, whether the loan is recourse or non-recourse, and of course the particulars of the specific loan transaction and the property, which is the collateral. Let's consider a few alternatives. In some instances, the loan is simply maturing and the lender will not renew. Unfortunately for the lender, I guess I'm going to speak right to you, Ms. Lender. Unfortunately, there's no exit strategy for you. They may not want to foreclose and own the property. Reluctantly, they may agree to a short-term extension in consideration for a principal reduction, an interest rate increase, and/or additional collateral. What precisely will be agreed depends in large part on the existing collateral and the terms of the loan and whether or not it's personally guaranteed. In other instances, it may be agreed the property will be conveyed by the borrower to the lender in lieu of foreclosure and complete discharge of the debt. In yet another scenario, the lender may agree to cancel the debt in exchange for a discounted payoff, either from the borrower or a related or unrelated party. All of these scenarios have differing federal income tax consequences, which we'll explore in more detail. In addition to the federal income tax consequences, there may be other expenses which are unforeseen when the deal's being negotiated. We will look today at 3 specific scenarios. First, let's set out the facts. And we're going to talk today about Bob and Steve. Do you guys know Bob and Steve? No? You know? Do you know Bob and Steve? Okay. All right. In 2006, Bob and Steve joined together to form Florida Property LLC, a Florida limited liability company. Florida Property LLC buys a shopping center in that year for $25 million. Bob and Steve were doing pretty well then. Remember 2006? Oh, that was so good. Bob and Steve each put in $2.5 million in cash and borrowed $20 million from bank and corporate. You know, what lender do you work for? Wells Fargo. They borrow. Wells Fargo. Okay. They borrow. We need to pick on Wells Fargo, but in the nicest possible way. They borrowed $20 million from Wells Fargo. The loan matured on November 30, 2011. You probably have this file and maybe 20 of these files, right? The current balance of the loan is $18 million, and due to the loss of a number of significant tenants, the property is now worth only $10 million. The loan calls for monthly payments of principal and interest based upon a 20-year amortization, and the interest rate is 5%. So to recap so far, we have a parcel of property worth $10 million and a loan of $18 million. For the last year, Florida Property has been unable to make the monthly payment, so the loan is in default, and the special asset, are you in special assets? Okay. And the special assets department, that's good, has taken over responsibility for this loan at Bank Incorporated. After increasingly difficult discussions between Bob and Steve and Wells Fargo bank officers throughout the year, they have focused on 3 options. We're going to look at the tax ramifications of each one. All right, number 1. The first option involves a complete restructuring of this loan. And the people at Wells Fargo do not want to do this, okay? But maybe we can convince her to try it. The maturity date will be extended for 3 years. The bank has requested that the borrower make a principal reduction at the time of this restructuring. The borrower is unwilling or unable to do so, but is willing to agree to increase the interest rate from 5% to 6% and to pay 100% of the net cash flow from the property to Bank Incorporated. Bob and Steve have asked for a complete restructuring of the repayment terms, including a reduction in the amount of the loan. Bob and Steve are very creative. To support their request, they're willing to give the bank an equity interest in another project. They may be willing to agree to a contingent payment from another project equal to the requested principal reduction. Perhaps Bob and Steve may agree to remit all net cash flow from another one of their projects. They can't quantify what that will be, and they won't give a mortgage on the property, but they will agree to remit the net cash flow. In consideration of this additional collateral, they want their personal guarantees to be canceled. So that's number one. Number two, it's possible that Bob and Steve just give up. They can't come to terms with the bank. They have no more resources and their guarantees are worthless. They agree to convey the property to the bank by deed in lieu of foreclosure or cooperate with a so-called friendly foreclosure. In exchange, they want a complete release. Third, Bob and Steve might agree with the bank incorporated to a discounted payoff. They've convinced the bank that given the reduction in the value of their property, they will put no more money into it and that their guarantees are worthless. Bob and Steve know that they can find or raise $10 million and that the property is worth and offer that to the bank as a discounted payoff. Perhaps their access to other funds comes from a wealthy family member who is a related third party, or from a vulture fund, which is an unrelated third party, who provides either debt or equity to make the discounted payoff to Bank Incorporated. The bank accepts. So to recap the three options we're going to talk about today, they are: number one, a complete restructuring of the debt; number two, giving the property back to the lender; and number three, a discounted payoff. So for the analysis of those three scenarios, I'm going to now turn the program over to Steve and Christine.
Thank you. Times have changed. We would never have thought about having this seminar in 2006. In 2006, we were talking about how to minimize the gain that you have when you sell real property. But where we are today, unfortunately, is this is certainly not uncommon as to where we are. The basic scenario is we have a property, we're going to call it Blackacre, and it's an investment property. It's held for a number of years. The value's tanked, and so it's underwater. That's the basic scenario. When we get to some real details, we'll have some numbers on the screen that you can see. What we have, to recap the important information that we need from a tax standpoint, we have a debt of, originally was $20 million. It's been paid down to $18 million. We paid $25 million for the property, but it's only worth $10 million. So again, we have, we're $8 million underwater, and we have a maturity date that's now or overdue. Okay, not an uncommon situation. We also have a property under our facts that's in the name of a limited liability company, which is treated as a partnership for tax purposes. But that's an important factor is what kind of entity holds the real property is important to the tax consequences. Okay, what are the options for approaching the lender about a workout? One is a modification to the debt, and that modification can be getting rid of the debt, getting new debt, or just modifying the terms of repayment. A modification of debt's the first one. The second is some form of a transfer of the property. Hard to sell the property right now, but a transfer of the property more likely to the lender in this scenario.
So the two general tax consequences that need to be analyzed when you're doing anything involving your debt are cancellation of debt, which we call COD income, and sale or loss from the exchange of the debt. Cancellation of debt income is always going to be ordinary income unless you have an exclusion, which we'll talk about some more, which is always a bad consequence, right? Phantom income, you have COD income, but you haven't gotten any cash in your pocket. And then if you actually give up the property through any of the scenarios that Vicki talked about, then that's treated as a sale of the property, and then you're going to have to analyze what the character of the gain or loss is, and that depends on whether or not it's investment property or dealer property. And the real problem is if you have capital loss on your sale of the property or some sort of capital result, but you have ordinary income from the cancellation of debt, that doesn't match. You're going to have ordinary income, capital loss. You're going to have to find some other way to deal with that cancellation of debt income. So if you do realize COD income, which as we said is ordinary income, there is some relief available under the code. Section 108 of the code allows you to exclude COD income in certain limited circumstances. The first circumstance is bankruptcy, but the debt has to actually be discharged according to the plan. So it can't just be sort of simultaneous with the bankruptcy. It has to be a part of the bankruptcy plan. The second exclusion would be if the taxpayer was insolvent immediately prior to the discharge. The insolvency would include looking at the debt that's being discharged because it's before the discharge, but you can only exclude to the extent that you were insolvent. So if you were partially insolvent and you were after discharge there was some solvency, you'd only be able to exclude part of it. Both of these first two are not elective, which means if your debt is excluded in bankruptcy or if your taxpayer is insolvent, then you have to take advantage of these exclusions.
You talking about the entity or the individual?
That's a good question. Thank you. I didn't plan them. If you're a partnership, these tests all take place at the partner level. So if the partnership itself is insolvent, if the partnership is bankruptcy, that doesn't matter. You look at the partners.
Even if the real property is, the partnership holds the real property, but you look at these exclusions at the partner level with a partnership. Right.
And that can be a real problem. Bob and Steve, Bob might be able to take advantage of the exclusion. Steve wouldn't. That's going to impact how they plan things, looking at what they're going to do with the property, because Steve's not going to, poor Steve's not insolvent. He's not going to have any exclusions there. Qualified real property business debt. If the property was, if the debt was incurred in connection with real property that's used in a trade or business, it's secured by the property, and generally if it's acquisition debt, which means that the debt was incurred either to acquire or substantially improve the property, then you can use the qualified real property business debt exclusion. Again, the partners have to see whether or not they have, one of the requirements for qualified real property business debt is that you have other real property interests that have enough basis to absorb this amount that you're trying to exclude. And again, you're looking at each of the partners to see whether or not they have sufficient basis and assets to do that. Qualified farm debt has to be incurred directly in connection with the trade or business of farming. The taxpayer themselves, you have to be able to look back to the 3 preceding taxable years to see if 50% or more of their receipts are attributable to the trade or business of farming. And qualified principal residence debt is more of a temporary provision. Right now, you can only take advantage of it if the debt was discharged before January 1st, 2013, although it's always possible they'll extend it.
Christine, can we go back to one or two real quick? What if Steve and Bob are LLC?
Repeat the question.
What if it's an LLC? How does that affect it?
So the question is if they're an LLC and not a partnership. An LLC for tax purposes can be taxed as either a partnership or an S corporation. I think in our situation, Steve said that they were electing to be a partnership, so it would be the same. You look at the partners instead of the partnership. If they're an S corporation, then it's the LLC itself. You look at what the LLC, whether or not the LLC is insolvent or bankrupt.
Could you repeat what you said about the income on qualified farm debt?
With a test for the receipts. The previous 3 years, the taxpayer has to have had gross receipts 50% or more attributable to the trade or business of farming.
What Christine has gone over is the exceptions to that. That even if you have cancellation of a debt income, if you are in bankruptcy or insolvent, or if you have one of these 3 types of property, you can exclude all or a portion of that cancellation of debt income and not have to pay tax on it. That's where we are now. I'm sorry.
When you're looking at applying these tests, all of the first 4, the 5th would just be individuals, but when you're looking at the first 4 tests, a corporation or an individual, you look at that person themselves. But if it's a partnership, you look through the partnership at the partners themselves in applying these tests. So a partnership being bankrupt or insolvent is not going to be relevant. It's going to be whether or not the partners themselves are bankrupt or relevant, or bankrupt, insolvent, have qualified farm, meet these tests.
But to make the point, an S corporation, most people think of an S corporation as somewhat like a partnership because they are taxed somewhat like a partnership. You know, they're a pass-through entity. If you have an S corporation that holds the real estate, you determine these tests at the S corporation level, not at the shareholder level. So that's the difference. Okay. And you can have a limited liability company that elects to be treated as an S corp. That's sort of rare, but if it for tax purposes is treated as an S corporation, then you make these tests at the corporate level. Okay. That is correct. It would be the assets inside the corporation tell you whether you're insolvent or not. If the S corporation is in bankruptcy, that's fine. But if one of the shareholders is in bankruptcy, he can't use the bankruptcy exception because these are all determined at the entity level if you're a corporation. Okay? Yes.
Number 5, an individual is qualified
There's
The
a
question was, what is the form to file for the exclusion for qualified principal residence debt? correct?
as off the accountants in the room may correct me, but for all of these exclusions, there's a form that you file that allows you to do what I'm going to talk about next, which is a tax attribute reduction. And I think filing that, it's like 982 or something, filing that form itself is how you make this election with the IRS, is by filing the form and reducing your
To
tax
answer your
attributes.
specific question, we don't know the form number, but we can get it to you after the.
I could tell
okay.
you, right.
Okay.
And I didn't say, but for the qualified principal residence debt, it's up to $2 million of acquisition debt on your personal property, your primary residence, which means that you can't have refinanced and taken the money out and done something not related to the house. It has to be the acquisition debt. Right, before January 1st, 2013. So it would be through December of 2012. Right now is how far that exclusion goes. So if you do elect to take advantage of Section 108, or if you're required to because of bankruptcy or insolvency, the sort of price of taking advantage of that exclusion is that you have to reduce certain tax attributes, such as your net operating losses, your NOLs, and tax credits, depreciation, and basis. So to the extent that you have some dollar amount that you're excluding, that form actually walks you through reducing the tax attributes so that in the future you lose some ordinary income tax benefits. One of the things that we talked about is modifying the debt, doing something that changes the debt that triggers the tax consequence. Any single one of these items is something that can result in a modification for tax purposes. Changing the obligor, reducing the principal, changing it from recourse to non-recourse, changing in the timing of the payments or the interest rate or the collateral, converting it to equity, or changing or releasing the guarantor. And the purpose of this list is some of these things would obviously make you think, oh, that's going to have a tax consequence, like reducing the principal, now you don't owe $3 million. That makes you think you might have COD income. But actually all of these things might give rise to COD income. So anytime you're making any kind of a modification to your debt, you need to consider the tax consequences.
So if you purchase, if you got a deal with the lender and purchase the note, let's say in this case it's an $18 million note and they purchased it for $10 million. And if they modify, an entity they're familiar with purchases that, if they modify that note, then it could have a debt consequence.
So the question is, if you have some other entity go buy the note from the lender for less than the face value, so it's 18 million for 10 million, a friendly investor, and they, again with the plants in the room, and they buy it for less, and they probably will. Usually they will go in and modify it because if they're friendly with you, they're not going to make you pay the full 18 million. Yes, when they modify it and you no longer owe, if they reduce the principal, if they reduce your interest rate, you could have tax consequences. We're going to talk about it a little bit more later, but it's definitely something that you need to stop and consider before you agree to have that transaction happen. Definitely, if they reduce the principal, you're going to have COD income.
If you will hold that question, there will be a slide about selling the note to a friendly and to an unfriendly purchaser.
You're jumping ahead of me. So the second thing that we talked about would be transferring the property. So you could have a short sale where you're conveying the property to some third party, but the lender agrees to go ahead and write off the remaining debt. A deed in lieu where you give the property to the lender, or a foreclosure where they force you to sell the property so that they can take the money. And the last thing that we talked about, transferring the note. You could have a friendly investor. You could have somebody that you know go in and buy the note from the lender. You should watch out for having that friendly investor be a related party. We're going to talk about it a little more later, but if a related party acquires the debt, it's just like you acquired the debt yourself, and that can give you some problems that you weren't anticipating. And finally, you could just maintain the status quo. You can keep trying to make your payments, or you can stop making your payments. If you stop making your payments, you are going to have a risk that it's deemed a modification. If your lender just never enforces it and you haven't been making payments, the IRS is going to say, well, even though you didn't put it in writing, you've really modified it because you're not playing by the terms of your original loan.
So what Christine has just been talking about is what makes up a modification, and basically anything that changes the debtor, the guarantor, the interest rate, the payment terms, any of those things can be a modification. And now the question is, what are the tax consequences to such modification? If it is a significant modification, it could be deemed under the Internal Revenue Code to be an exchange of the old note in return for a new note. Even if you didn't really get a new note, you're just modifying the old note. It's treated as if you got rid of the old note and you got a new note in return, and you have cancellation of indebtedness income to the extent that the fair market value of the note is less than what you owed on the old note. Okay, so it's like you really got a new note, even if you called it a modification. Okay. Okay, what is the fair market value of the new note? In many situations, the fair market value of the new note is really the principal amount of the new note. So unless you're changing the principal, that may not be a modification that triggers cancellation of debt income. However, if the note is one that is termed to be a publicly traded note, then you have a different rule. And realize that publicly traded doesn't necessarily mean that you can go and buy it on the stock market. It basically means, is it an obligation that your bank bundled with some other loans and sold off to somebody else? If it's in that category, it's deemed to be a publicly traded note. And in that scenario, the fair market value of the new note is what is looked at. So if you did change the guarantor or change some things so that the fair market value of the note went down, you very well may have cancellation of indebtedness income, even though it looks like the principal amount is still the same. That's one of the real traps, okay? Okay, let's get to some specifics. What we had, to recap what Vicki said, is we had an original debt of $20 million. Right now, it's $18 million is outstanding. We originally paid $25 million for the property, and it's worth 10. So the relevant facts are we have $10 million piece of property with $18 million loan on it, and it's owned by a limited liability company or partnership. Were our set of facts, okay? Okay, the first scenario that Vicki gave was the lender is willing to agree to a principal reduction from $18 million down to $12 million. Okay, but you're going to change some other terms, increase the interest rate or something like that. Or secondly, we're going to require some personal guarantees. I'm sorry, we're going to cancel some personal guarantees, okay? So the first part of that is we're going to modify this loan to reduce the principal. Okay, and we had a debt balance of $18 million. The lender has said we will modify it down to $12 million. The result of that is $6 million of cancellation of debt income, $6 million of ordinary income that is taxable unless one of the exclusions apply that Christine talked about. And the point here is that the taxpayer still has the piece of property. He hasn't given up the piece of property, but he has done something to get himself out of debt. That's a taxable event, generates cancellation of indebtedness income that is taxable unless you are insolvent, etc., or one of the exclusions applied. So we've triggered tax consequences without getting rid of the property. So you can see that the exclusions that Christine talked about are extremely important. Okay.
And I'll jump in and say your question about if you have a friendly investor, so let's say your friendly investor comes in and buys your debt from $12 million from the bank, and then they agree with you to write it down to the $12 million that they paid for it because they're friendly. This is what your tax consequence is going to be. Your partnership or your S corporation, whatever, is going to have $6 million of COD income. And here's a good spot for looking at the difference between a partnership and an S corporation, because the partnership isn't going to matter if the partnership was insolvent prior to this write down. It's going to matter whether or not the partners were Bob and Steve. Whereas an S corp, you would just look to the S corp itself. And this is also sort of your best situation for taking advantage of the qualified real property exclusion, because you still have the property, and that exclusion requires you to have real property that you can write the basis down on. So in this situation, the property's still there. You will very likely be able to take advantage of that particular exclusion.
Now, the second scenario here was what happens if the lender agreed to release the guarantees? Now, when you talk about releases of guarantees, let's suppose one of the guarantors was Bill Gates. You can see that releasing his guarantee is something significant and does affect the value of the note, okay? So even though we don't change the principal, you can see that the value of the note instrument has changed, okay? And the first test is if the debt itself was not publicly traded debt, as I talked about before, and we've released the guarantor, there would not be any COD income, because if it's not publicly traded debt, you just compare the old debt balance with the face amount of the new debt. And here we didn't change the principal in my example, we just released the guarantor. However, if this was the kind of a loan that the bank had bundled up and sold, i.e. publicly traded debt, and we released a guarantor, and now the value of that new debt has gone down to $12 million, we basically have cancellation of debt income of $6 million in this example, okay? So a real important test is what kind of debt are we talking about? And the term publicly traded debt is a little bit confusing because it is certainly nothing that is bought or traded on the market, but it is what did the bank do with that debt, okay? Vicki has a question, and this one might have been planted, I'm not sure.
No, I really, because I have a file like that right now, and when banks come into town and buy other banks, they look at their books and they right size their loan portfolio to some extent. That's what we call right sizing. So they probably have paid, let's say they've paid 50 cents on the dollar for their loan portfolio. They're just buying deposit accounts. Then they hire a broker to sell their entire loan portfolio, a couple of $100 million. And there are not a lot of companies that are buying $200 million portfolios without raising, without financing. So it's a very small set of players. But I happen to represent a borrower on one of those right now. And so that would be publicly traded. I mean, this is put on the internet, they bundle, they sell their whole this bank that comes in and says, I bought it, I right size it, I want to get rid of it. And when those people, those handful of people who buy those portfolios, they buy it, then they're going to call us and say, okay, you're in default, now we want to talk to you. You're telling me already my borrower has already had some sort of effect, or what's going to happen there now in this context? You understand my question?
I believe I understand the question. She's saying if there was in effect, a sale of this bundled group of loans, could there be tax consequences at that time? And the answer is yes. If something had to happen. If somebody just bought the loan and they weren't related.
Well, they paid less than face.
The value of the loan that they bought was still $3 million. They just bought it for $1 million.
Right,
Yeah, let's
right.
say that.
In the package.
But, okay,
They publicly
The face amount of the loan has not changed.
Right.
Borrower still owes $3 million.
Right.
and as long as we still have the same guarantor, we haven't modified, as long as you didn't modify the loan at all, and as long as it, as long as
I have a bunch of them, but there's one just like this now. I didn't understand publicly traded until you just.
as long as, if somebody buys the loan and they're not a friendly party or related party, okay, and you don't do anything to the loan, there's not going to be any tax consequences. It's only if somebody bought this loan and at the same time,
At the same time.
or in connection with that, somebody released the guarantor, okay?
Okay, well, we're waiting for that call. so-
Okay, all right.
And I would the issue should be if you borrowed money from a family member or a friend or just an individual who's not in the business of trading, probably you're not publicly traded debt. But anytime you have any debt that involves a bank, you need to make an analysis of whether or not it's publicly traded.
Okay, so I've been talking about, in general, what are the tax consequences to doing something to modify the loan, and is there cancellation of debt income? Now we're going to go over and talk in general the tax consequences to transferring the property to the lender.
So if instead of modifying the loan, you agree to do some sort of transfer of the property, the issue is going to be whether or not the debt is non-recourse or recourse. Non-recourse being that no other property than the property that secures the debt is at risk. Recourse being that there is some other assets that the lender can go after to pay the debt. In our situation, our principals have personally guaranteed the debt, so it would be considered a recourse debt. So if it is a non-recourse debt, it's all sale or exchange treatment. The full amount of the debt is deemed to be the purchase price for the calculation of the gain or loss, and you have no COD income. It's all going to be sale or exchange. So all those exclusions won't help you. You're just going to be looking at the sale or exchange analysis. And your primary issue then is just going to be the character of your gain or loss, depending on why you held the property, whether or not you're a dealer or investor. Dealers, it would be ordinary gain or loss. Investors, it would be capital gain or loss. And if it's recourse debt, like we have here, it's a bifurcated analysis. You have sale or exchange treatment still to the extent of the fair market value of the property, and you have the same character or gain issue, depending on whether or not you're an investor or a dealer. And then to the extent that the debt exceeds the fair market value of the property, that's where your COD income is going to come from, and that would be ordinary income. And as we mentioned before, the problem here with your recourse debt is your sale or exchange could give you a capital loss. Your COD income is always going to give you ordinary income. So this matches up with Vicky's second scenario where Bob and Steve have given up on trying to pay their debt. They don't have any more resources and their guarantees are worthless. So they agree to convey the property to the bank by deed in lieu of foreclosure or to cooperate with a friendly foreclosure. And these same tax consequences would apply if you had a short sale. If they found somebody else that was willing to buy their debt and the bank agreed to accept that, you would have the same treatment. So the tax...
In reference to that, though, is it fair to Bob and Steve, if based on the fact that Wells Fargo out-negotiated Wachovia, got Wachovia to drop their sale price, so their new portfolio that Wells Fargo owns is at a devaluation, why shouldn't the new owner of Wells Fargo pass some of that devaluation along to Bob and Steve? Why are they going to force them to sell at a big
They
price,
might.
and then they're going to get the full value over here, and they got discounted value over here? Why should Wells Fargo be the winner in this scenario? Why shouldn't Bob and Steve get any benefit?
They could. I mean, Wells Fargo could. This is just an example. Wells Fargo could say, well, we only paid 50% for this debt, so we'll decrease the principal on it. It doesn't matter what you agree to with your bank. The IRS is going to say, you borrowed $20 million, but they're only making you pay back 10, so you've realized some $10 million income. But they could, I don't know.
Yeah, and that will help Wells Fargo to be in a position to negotiate, but they won't do it on the first pass. I mean, you got to go to bat a bit, but that's the right sizing that'll happen.
I don't think IRS is fair or polite to say that that's their office anyway.
Can we have your name so we can give it to the IRS? Is that
So there are no IRS agents anymore. So the tax consequences if you do have a transfer of the property, in our situation, again, we have a recourse debt because the partners had guaranteed the debt. So that's the bifurcated transaction. The first step is the sale of the property. The purchase price for your sale is the fair market value, so $10 million. You had a $20 million basis, $25 million basis. The $20 million you borrowed plus the $5 million of cash those partners put in, $25 million basis. So our partners have realized a loss of $15 million. And the issue is going to be whether or not it's capital or ordinary. I think we said it was investment property, right? So the second step is the tax cancellation of the debt cancellation of that additional debt above the fair market value. The total debt was $18 million, but you've deemed to have been made a $10 million payment by transferring the property to them. So they're writing off an additional $8 million, and that's the amount of your COD income. So you have a $15 million loss and $8 million of COD.
so that's good news then, right, or not? You have an overall net loss.
You have an overall net loss, right? No, not necessarily good news. Actually, in our case, bad news because we have investment property, which is going to give them a capital loss. So they have $15 million of capital loss, which they cannot offset against their $18 million of COD, and they no longer have the property. So they probably, might not be able to take advantage of that qualified real property debt exclusion unless our partners have other real property elsewhere that they can reduce. They may or may not be insolvent.
Talking about investment property here?
Investment property. In our example, if it was dealer property, the problem now, in 2005, everybody was arguing that they were investors. Oh, we're an investor, we're not a dealer. Now everybody's trying to argue that they're a dealer. It's a hard argument to make. We've whipsawed them. And then assuming in our situation we don't have enough loss, we don't have loss that can offset our COD, then you go back and you look at your Section 108 exclusions and see if you can find any.
Okay, Vicky's third scenario was, what happens if we talk to the bank and we convince the bank that they should take $10 million for their loan, either from Bob and Steve's father or from an unrelated joint venture or something that's come together, but the bank is ready to get out. They don't want the property. They're ready to sell out for $10 million to somebody, okay? That's the scenario we're talking about now, okay? And what are the consequences of the transfer of the note? And they're different if it's a related party versus an unrelated party, okay? So we want to go over those. If a related party acquires the debt, and related party is specifically defined, but you can guess where part of it's going to be. If a family member is involved, if it's an entity that you control, if it's a related party, a bell ought to go off in your head. If a related party acquires the debt from the bank, it's treated as if Bob and Steve bought that debt, and it's treated as if then the debt obviously was written down to the amount they paid. So they have cancellation of debt and this income to the extent of the write-off, okay? If it's an unrelated party that buys the note, and it's truly an unrelated party, and there's no change to the note. Vicki was talking about potentially there being a change to the note, but if an unrelated party buys the note, doesn't release anybody, doesn't write the debt down, then we're not going to have any income tax consequences, okay? Very often, when somebody buys the note, there's going to be a modification afterwards, but the modification might create consequences.
And
Yep.
the related party, if there's no modification of the note,
Well,
straight note.
well, let me go to the next slide has this here, okay? What are the tax consequences if a related party goes to the bank and buys that note for $10 million, okay? Doesn't modify the note, doesn't do anything, okay? It's treated as if the taxpayer bought the note for $10 million and in effect got released from the rest. So we had a debt of $18 million, we paid $10 million, we have cancellation of indebtedness income of $8 million. The theory is the related party is going to really let you off the hook for the rest of the debt. It's as if you bought the note for only $10 million where you owed $18 million. It's like you paid off the debt.
But shouldn't it be at the time that the debt's released? What if they make you pay out the full amount?
The key is related party. The key is related party. So if somebody's going to buy the note, and you say let's set up a new entity to buy this note, you don't want to be owning 55% of the entity that buys the note because then it's going to be a related party. If you participate in that entity to a minority, in a minority role, then it may not be a related party and it won't trigger the consequences. But probably the one point to take away from this meeting is if you have a deal with the bank and you're going to get a reduced payoff and somebody they're willing to sell the note to somebody, you need to make sure that's not a related party, because if it is a related party, then you have all of the adverse tax consequences, you still have the real estate, and if the related party isn't friendly, you still owe the rest of the money. So the assumption under the Internal Revenue Code is the related party is going to let you out of the rest of the debt, and it happens immediately, not when they ultimately modify the note. That's one of the big points of today, okay?
But if the note is never modified, if the related party bought the note, let's say there were 4 partners in a deal and 2 of them bought the note in another entity, and the note was secured by income-producing property, and the entire note ended up being paid back. It was never modified, it was all paid back. Is that triggered?
Let me restate the question. He said, so if a related party buys the note, does not modify the note, and the note ultimately is paid off in full, the answer is when the related party buys the note for less than the amount owed, there is income generated at that time, because the assumption is there's going to be a modification of the note. So the key is, if somebody's buying the note and you are one of the obligors on the note, make sure that that's not a related party that does it. And the related party is your parents, it's entities you control. You can avoid it by not having a majority control of this. But that is the point here, is that if a related party buys a note that's underwater, it's deemed to be that you got to pay off that note for the amount that the related party pays. Okay?
So one of the important points was don't let a related party buy your note. Our other important points are anytime you modify your debt, you need to consider what the tax consequences are, and that's any modification, not just reducing the principal. Don't use a related party to buy your debt. If you do convey the property to the bank, you can potentially have two tax consequences. You're always going to have a sale, and if it was recourse debt, you're also going to have COD income. And the character of the income and the loss on the sale might not match up with your ordinary COD income, and that could be a problem that you're going to need to plan around. The exclusions of COD income may be available to avoid taxation, although they're going to have that cost later on the tax attribute reduction. If you're a partnership, you test it at the partner level. If you're a corporation, a C or an S corp, you test it at the corporate level. It really just serves as a deferral. You're going to lose that ordinary income later on down the road doing some sort of tax attribute reduction. The deed in lieu and the short sale, they have the same tax consequences as a foreclosure. So anytime you're getting rid of the property, you're going to have that same sale loss analysis. And then, as we talked about, the type of entity is very important, whether or not you're a partnership versus an S corporation. Nobody considers that when they're forming their entity, but it is going to be important in a situation like this.
All right, so we've saved about 10 minutes for Q&A. Let me just say before we start that, another one of the lawyers in our Dean Mead office has attended, Paul Goldman, who's in the back there, and Paul does family law. And I'm going to tell you, if you bought a piece of property for $25 million that's now worth 10, you might need Paul. You're going to have a little stress at home over. Yes, there's a lot of economy-driven divorce work, so Paul can help you. And the other takeaway is obviously we've glossed over some very complicated stuff in 1 hour. So the takeaway is if you're doing one of these, and we've got, as a transactional real estate lawyer, I have so many of these files on my desk right now. It's very complicated, but we have a lot of experience in this, and we can help you. So call us. All right, Q&A. Anybody have? We've had a good open debate on some of these issues. Anybody else have any questions?
We have a hotel that the bank canceled $3 million debt, meaning it was a $6 million note, and the party went ahead and voided the $3 million as a cancellation of $3 million. But there's a basis in the hotel of $5 million still there after depreciation. So just lower that basis.
I was gonna let Vicki answer that, but I don't think she wants to. I think the question was, there was a $6 million debt that was canceled down to $3 million. Was it canceled in connection with the sale, or that was all that it was?
They paid it off.
They paid the $3 million off. They were released from the rest, and they still have the property.
Is your name Bob or Steve?
In that scenario, there is, if the bank lets you pay off this note for $3 million and $6 million was owed, you have $3 million of COD income, and it is, and if it is a
Are you
individual,
a partnership or?
if it's an S corp that does this, then the question is, does the S corp itself meet any of the exclusions? Is the S corp insolvent? If that's the only asset that it had, it may be. So it could use the insolvency exception to exclude that from income. And if it does have that exclusion available, it may have to reduce its tax attributes and reduce the basis of other property that it has. Okay. It was insolvent before. It's the test immediately before, were you insolvent? Yeah, if that property was worth $1 million, let's say, they still have $1 million of assets, but let's suppose that they owe somebody else some more money. It could be insolvent, but you are correct. You have to look at all of the assets of the S corp to see if it's insolvent. Right, immediately prior. Right. But you enjoyed it though. Okay. Yes. Well, I think they're defining it the same way today as they used to. It's just we're defining it differently. I think we're trying to get in the different pigeonhole, if you will. What she's getting at, the question was, how is the IRS defining a dealer? Until 2006, as you know, we had lots of real estate development here. And what people wanted to do, the distinction being capital gains are taxed at a much lower rate than ordinary income is. So if you were going to go buy some real estate and it was always going up in value, which it did, and you were going to sell it, you wanted to sell it and be a capital gain. The real test is, have you done something to that property with the thought of dividing it into lots, improving it? The typical example being somebody buys it, maybe gets a zoning change, and then sells it. Okay, that would probably be not enough to make you a dealer. But if you have bought the property and you put streets in or drainage and made improvements to the property with the thought of subdividing it and selling it, that probably is dealer property. Well, if I was a real estate broker, for example, and what I did for a living was I bought and sold individual houses, then maybe it is a dealer, but most likely it is not a dealer if you just had somebody who went out and bought one house, okay?
Is there a statute of limitations from the IRS point of view, meaning you have the COD debt, they're overwhelmed with how many cases they have to handle presently, you drag your feet, and 7 years later, you say, hey, they forgot about me, that's gone?
Well, let me restate the example without giving your name, by the way. The question was, what's the statute of limitations for the IRS coming at you, okay? And there is the various statute of limitations. The general statute of limitations says if you have filed an income tax return, it basically is 3 years from the time you filed the tax return, okay? Two exceptions to that you need to be aware of. One is there's something called a substantial omission from income. If you have omitted something that is a significant portion of your income, had you included it, then but you still filed a tax return, then there is a 6-year statute of limitations, okay? However, you have to be aware of one other. If you deliberately, if you know that you've got income that's supposed to be included on a return, and you don't include it, that is fraud, and there's a criminal penalty, and there's no statute. That goes on forever, okay? So if you made an honest mistake and didn't include something, it's either a 3-year or a 6-year. But if you knew that you should have included it and you said, well, maybe I can just get by, that's criminal tax fraud, and there's an unlimited statute of limitations there.
Also, if the bank is involved, they're going to send you a 1099 with a huge amount of COD income. So the IRS is going to have been put on notice that you had this happen.
One more, yes.
The 1099 trigger that taxable income, or is it, are you imposed to disclose that, say, if you bought a note at a short price?
Can you say that, I'm not sure I follow the question totally.
Let's say you bought the Bob and Steve scenario and they paid $10 million for the $18 million note. Then the bank, Wells Fargo in this case, would say, okay, you've got an $8 million 1099 coming your way. Is that the trigger for the tax?
Let me restate the question. The question was if there was an $18 million note and somebody bought it for 10, and let's say it was a related party, so it was going to trigger some income, is the bank going to be giving a 1099? In that scenario, no. The bank wasn't involved with the borrower and didn't let the borrower off the hook. The bank just sold the note for $10 million. So there wouldn't be a 1099 that's issued in that example.
The question is, do you declare on your taxes that forgiveness at being notified of the 1099 on the forgiveness?
Well,
How does the taxpayer know when a debt's been forgiven if somebody buys the note at, let's say, a public note or a public sale? How would the taxpayer know when that?
The bank or your creditor. So the question is, how do you know that you have COD income? The 1099 is just a reporting obligation. That's just somebody saying this tax event happened. It's not really, it doesn't trigger it. It's just telling the IRS about it. What really triggered the event is when you sat down with whoever your lender is and you signed a paper saying, we agree that we're going to write this off and you're not going to enforce us against that additional $8 million or whatever that you're forgiving. There's going to be something that you sign that makes that happen.
But if you never signed anything, the note was bundled and sold to a third party out there. They bought it for 50 cents on the dollar.
Well, remember on our last situation, if an unrelated party changes your debt and they don't change anything, then you don't have any tax consequences. The only tax consequences are going to happen when the modification happens. You have to actually modify the note. So just selling the note doesn't do anything to the debtor. You're in the same situation you were before, as long as it's not a related party.
I think I know the answer, but I got a little confused about the LLC. The LLC can be an S corp, correct?
Yes.
It's just a tax election.
An LLC can be an S corp or partnership or corporation, right?
But if it does, the question was, can an LLC be an S corp? An LLC, unless it makes an election, is treated as a partnership. So, but if an LLC elects to be treated as an S corporation, it can, but it has to affirmatively make that election. So that's why we usually say an LLC is taxed like a partnership.
And I won't go into a long story about this, but somebody did ask us last time we did this. You can't just elect to be an S corp right before you do this transaction and get out of these tax consequences. That won't work.
All right, so I have to thank our Wells Fargo banker for being such a good sport. And thank you all for coming. We have an evaluation form we'd like you to fill out. Let us know how we're doing, because we're going to do a whole series of these. And you can help us make them relevant to you and enjoyable. And thank you again for coming. And we'll be here for a few minutes if you have any other questions.